Welcome back to this channel. And today we are tackling the last question on August 2024 BDA sitting. And the last question is question number 24. So far we have tackled question number 21, question number 22, question number 23, and question number 25. And today we are tackling question number 24, which was testing on auditing. And I'll read through the question. But before I read, if you are new to this channel, kindly consider subscribing. To this channel so that we can be able to reach many. And for those who have subscribed, we say thank you. Thank you for considering subscribing to this channel. So back to the question number 24. As an audit senior at Herufi Audit Firm, you have been made responsible for planning the audit of Lead Team Manufacturing Limited for the year ending at 1st December 2023. Below is a summary of key information about Lead Team Manufacturing Limited. So I've been given that revenue, net income, total assets, inventory, and accounts receivable. The accountant at Lead Team has further provided you with the following list of account balances as at 31st December 2023. So I've been given all that information there. Additional, as at 1st December 2023, accounts receivable balance included 250 due from a customer who has been declared bankrupt, while accounts payable were found to have been overstated by 150,000. The allowance for doubtful debt is to be adjusted to 3% of the accounts receivable as at that 1st December 2023. As at that 1st December 2023, there were prepayment of 50,000 and 75,000 towards administrative and advertisement expense respectively. For the same period, there was an accrued amount of 120 towards audit fee. The company paid the due interest on long-term debt on 7th of January 2024. Then depreciation is provided as follows. Building is 5% per annum on cost. Heavy machinery, 10% per annum on reducing balance. And the company annual general meeting resolved that preference dividend be paid, a dividend of 11% on ordinary shares be paid, and 3 million be transferred to the general reserve. The company maintained a gross profit margin of 25%. Having been made aware of the significant changes in ERP system, the CFO position, and business routes, you are concerned about the materiality assessment of the audit. So you are required to determine the planning materiality for audit based on the revenue, net income, and total assets. Justify your choice of the basis and the percentages used. Then prepare original, adjustments, and adjusted total balance with the debit and credit column each. So 6 columns that we need. So here the first question was dealing with materiality, and the second one was to prepare the audit schedule. So we shall start with the question for materiality. So determine the planning materiality. So remember, materiality normally affects the true and fair view of financial statement as they are presented, and therefore materiality is supposed to be considered by the time you are dealing with planning. When you're planning for the audit, you're planning for audit risk, and one of the risks that you'll be planning for is this materiality, so that you know whether it is material or it is immaterial. So those that are material will affect the final decision of the final opinion that we shall give as the auditing team. And if it is immaterial, then it will not affect the final decision, or it will not affect the true and fair view. And in this case, we have been given 3 items that you're supposed to deal with when you are calculating this materiality. So we are basing it on revenue. We shall base it on revenue. The second one is net income. I think net income we have been given at the beginning. Net income. And the third item is total assets. When total assets have been given. Yeah, so here we have their value. And for this one, so the value of revenue is and they are in thousand. First, in thousand of shillings, in thousand of shillings. Yeah, that way. And this one I can put, need to see why it is that way. Okay, it's not responding. Okay, so for this one there was some space that was left. I need it to be at least at the center. Yeah, that way, so that even this one is already at the center. Yeah, that one is okay, so that our value of revenue that we have, so revenue is 75,000, and these other one, let me see whether it will be able to pick the other values. It is not. So revenue, then net income, then we have total assets, that way. Then we are told we justify the choice. So this is our revenue. We need to have the benchmark, materiality benchmark, materiality benchmark, materiality benchmark percentages. There are percentages that are within. If it is revenue, the materiality is supposed to be within a certain percentage. If it is net income, the same thing, and the total assets, the same thing. So for revenue, at least materiality for revenue should lie between 1% to 3%. Yeah, it should be 1% to 3%. Minimum of 1% you can take, and maximum of 3%. For net income, normally we talk about the profit before tax, earnings before tax, which is given 3% to 10%. Yeah, it should lie between that. And for total assets is the same as the revenue, 1 to 3%. Yeah, so this is what we are justifying the use of the percentages. It should lie between that 1% to 3%, 3% to 10%, 1% to 3%. Yeah, this one benchmark. Remember, whenever you are dealing with materiality, it is based on the auditor's judgment. Yeah, it is not a fixed value. You can use higher, you can use 7, you can use what it is within the auditor's judgment, so that the amount when it passes, like in this case, if it's net income passes 10%, surpasses 10%, then it becomes material. But if it is within this range, then it is not material. It is not material. So in this case, I will calculate for 1%, I will calculate for 3%, and I will calculate for 10%. I think those are the three ones that we have, the three of them for 10%. So 1%, 3%, and 10%. So that for this one, it can either be this one multiplied by 1%, which will be 750, and still this one, it can be multiplied by 3%. So the maximum we can have as our materiality level is 2250, minimum is 750, and the revenue when you're taking 1%. So if a value lies above this 750 to 250, 2250, that one we shall term it as immaterial. Above that, then it will be termed as material. Above that, it will be termed as material. Here, we are calculating 3%, which will be 217, and 10%, which will be 725. So again, in this case, if a value lies between 217 to 725, above 725, the value will be material, and the statements will not be presenting a true and fair view. For total assets, we are having 3%, and we are having 1%. Again, this one should lie between 850 to 2250. 850 to 2250. Yeah, 850 to 2250. So you wonder where 3%, both of them, they are giving the same value. Yeah, Okay, so this is 22 and this is 25. I thought they're the same. Yeah, so it will lie. So that is where our materiality. So remember the question was determine the planning and materiality for the audit based on the revenue. Justify your choice of the basis and percentages. So the basis, if we are using revenue, net income, and total asset, the basis will be determined by what the shareholders need. Yeah, what are the needs of the shareholders yeah, of this particular company. Mostly you'll find that for companies, whether public or these are manufacturing and it is a company, you'll find that shareholders they're interested with the profits, and most of the time we normally use the net income or the revenue because it will depend with the needs of the shareholders. Yeah, so the choice of here you can say the choice of the base will depend will 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 depend on the shareholders shareholders needs. Yeah, shareholders needs or the users shareholders needs, but mostly the net income, mostly the net income is used. The net income is used. The net income is used. The other key thing, the percentages, the percentages, percentages, percentages will be based on the benchmark, benchmark, where one can use maximum or minimum, depending on personal judgment, because you have said in this case professional judgment is one that comes in place or in play, and that's how that particular first part of materiality was supposed to. So for the second part of the question, we need to prepare the original so we shall have the original. Need to see, yeah, I'll just use here. I'll have the original trial balance, original trial balance. Then, so remember, you normally have the debit and the credit. Then we have the adjustments, and for the adjustments, so control copy, control paste, and we shall have the other thing. So still here you can paste. The other thing is the adjusted trial balance, adjusted trial balance, trial balance. Yeah, that way. So those are the 6 columns that they need us to have, the 6 columns that way. Yeah, so that is our 6 columns: the original trial balance, the adjustments, and the adjusted trial balance. So here we'll pick the values as they are here, starting with this one, accounts payable, and I will drag this. So that is up to building, yeah, audit fee, administrative, retained. Yeah, I think up to that is the end. I delete this. Okay, so it has picked until, so this part is not supposed to be there. Yeah, I'll delete this part. Yeah, after the retained. So the retained profit was the end of that. So the only thing is to fix, yeah, the payable, we know that it's supposed to be on the credit side, which is for the payable, supposed to be on the credit. Yeah, payable, just pick it the way it is. Yeah, followed by receivable, which is supposed to be on the debit, receivable. So followed by cash, which is supposed to be on the debit, inventory. Yeah, these ones are up to that. So return outward, supposed to be on the credit, return outward, return inward on the debit, return inwards is for sales, then ordinary on the credit, whereby you can pick, yeah, there is this shorter way, you can just pick all in that, and here I pick all that way, so that will just eliminate instead of going back and forth. So return inward, ordinary, yeah, these three up to this point. I'll delete this, it's not supposed to be on that side. So purchases and bank overdraft. So here you'll eliminate purchases, I'll eliminate the overdraft. Discount received is on the credit, allowed is on the debit, building on the debit, machinery on the debit, accumulated depreciation on the credit, credit audit fee on the debit, administrative on the debit, and bad debts apart from allowance. Allowance is on the credit, this allowance at the beginning, and retained profit is supposed to be on the credit. And I leave some lines there. I'll find the total on this end, my total for the original trial balance, and I'll drag this for the 6 of them. Yeah, that way, and you'll find that there is a value there. So this is 199, 196 and 199. So there's some values. Yeah, bank overdraft is okay. So let me go back and just counter check that. Okay, return inward. Yeah, so in this case, return inward and return outward, we think we have fixed both. Return outward is supposed to be on the credit, return inward is supposed to be on the debit. So here we don't have this, they are not supposed to be true. I'll eliminate that, and you'll find that it is balanced at that particular point. Yeah, balanced at 196. Yeah, I will have top and bottom border that way. So that is the first part. That was the original, yeah, the original trial balance, the original trial balance. So we go to the second part for the adjustments, and our adjustments, they are in the additional. Like number 1, as of that 1st December 23, accounts receivable balance included 250 due to a customer who has been declared bankrupt. So 250. So we shall write it off. Yeah. So bad debts, I think I've seen bad debts. There was a bad debts. Yeah, bad debts on this end. So we shall debit here the 250, and it will affect the receivable. It will affect the accounts receivable. Accounts receivable here. Our receivable, we shall credit the 250. Yeah, the 250. And while accounts payable was found to have been overstated by 150, so the accounts payable, yeah, that means if accounts payable were overstated, it will have effect on purchases. Yeah, it will have effect on purchases. So it was overstated by 150, and our payables are here. So payables are overstated. So it means the credit is more. So we shall debit here 150, and if we shall debit and we shall credit the purchases. because purchases will be overstated again. So purchases will be credited. Yeah, purchases will be credited that way. Then number 2, the allowance for doubtful debt is to be adjusted to 3% of accounts receivable as of that 1st December. And remember, as of that 1st December, we have the 250. Yeah, we have the 250. So you can do some workings on this end. Some workings on this end. And the first one is allowance. So for the allowance of doubtful debts, I think I had it somewhere here. Yeah, no, let me just write allowance for doubtful debts, allowance for doubtful debts. And for this allowance, we are told it is to be adjusted to 3%. So remember, our receivable was this value. I'll open the bracket and I minus the 250, the one that was written off, and I multiply by 3%. So it's supposed to be 822, the allowance. So it's supposed to be 822 at the end. 8 at the end, allowance. So at the beginning, allowance was 300, but we are supposed to adjust it to 800. Supposed to adjust it to 822. Here, 822, and it will reduce the value. Okay, so that was at the beginning. So that means here you shall have 822 on the debit, and here it will reduce the receivable. Here we shall add that 822. Remember, in the income statement, if we are to prepare the income statement, we are supposed to include what? We are supposed to include the difference in allowance. In the income statement, we are supposed to include the difference in allowance. Then the next thing that we had, we have done with allowance, number 3, as of that 1st December, there was a prepayment of 50,000 and 75,000 towards administrative expense and advertisement. Yeah, you can have an account of prepayment, or you can prepare. So prepaid advertisement, prepaid administrative admin expense. You can put them separately, and accrued prepaid. So you have prepaid prepaid advertisement expense. So both of them were prepaid. So prepayment of 50,075, admin and advertisement. So 50,000. So prepayment is an asset. 50 and 75. So 50. So we shall debit this 50, and this one is 75. And we shall credit the respective. So admin here we credit with 50, and advertisement we credit with 75, because it was a prepayment. And the next thing, and for the same period, there was an accrued amount of 120 towards audit fee. Yeah, accrued audit fee of 120. So accrued audit fee. So this one will be a liability of 120, and we shall add it under the audit fee of 120. So shall add it in the audit fee. We debit audit fee, we credit the accrued audit fee. Then we are done with that note. Number 4, the company paid the due interest on long-term debt on 7th. So it was after, because we are closing the year on December. So this was after. When you look at the long-term loan, yeah, so 9% long-term loan. So we have interest here. Number 2, interest on loan. Interest on long-term loan. So this one we shall calculate it as this one by 9%. by 9%, which will be 405. 405. So we shall have that. We shall have this that way, and still we shall have it as accrued. Let me just copy this, and I will come and paste it here, and here we'll add the word accrued because it is yet to be paid. So here we shall debit this amount. We shall debit 405, and we credit the same amount, 405. Remember, you can have one account for accruals. Yeah, accruals still you can have separately, and you can have one account for those accruals. Number 5, we have the depreciation. Let's do that as working number 3 for the depreciation. Depreciation. So the first one is for building. Yeah, building. So for building, 5% per annum on cost. So the cost of the building, I think we had it somewhere. Yeah, building at cost multiplied by 5%. Yeah, it is 5% per annum. Then heavy machinery is on reducing. Machinery is on reducing. So reducing, we shall take heavy machinery. The cost was this with accumulated of 21, and the rate is 10% on the reducing, 10%, which will give you 820. So we have depreciation for the year. Depreciation for the year. So depreciation for the year. So for the year, we have for building, and here depreciation for the year for heavy machinery. Heavy machinery. So this is for the year. So for the year, we shall debit depreciation for the year. This one for building, and I will add that. Then we have the accumulated depreciation for building. We shall credit this value, and I will drag because they are together that way. That is our accumulated. Then the company annual general meeting resolved that preference dividend be paid. So number 4, so preference dividend, preference dividend. So for the preference dividend, can calculate it here. Our dividend, we had it here, 10% preference, so I take this by 10%. And also they resolved what? A dividend of 11% on ordinary share be paid. So ordinary dividend of 11%. So our shares, we had this by 11%, and you'll get that. So here we shall have the 2 again. We'll have these 2 that way, the preference and the ordinary. I will debit them here, and I will drag this as an expense. Then I will copy the 2 of them. I will come and paste. They will be accrued, so they will form part of the accrued expense. They will form part of the accrued preference dividend, and we have accrued ordinary. Remember, you can put one account. You can still put one account for that. Just need this to capture up to that point. So for the accrued, it will be the same value that we had here, 580, and I'll autofill these. I'll autofill this, yeah, that way. Then after that, we are done with the preference dividend. So 3 million is to be transferred to general reserve. So we need to see whether we had general reserve. General reserve. So here is where we had our reserves. And in these reserves, we did not have general reserve. So general reserve. So shall have general. So general reserve. So we normally transfer it from the profit. We transfer it from the profit. And so general reserve. So we had 3 million. So 3,000. According to this, 3 million to be transferred to general reserve. And remember, we transfer it from the retained. So I'll just create an account, transfer to general reserve. Transfer to general reserve. So here we'll debit as an expense what we are transferring to general reserve. Others may still transfer it from the retained, but remember we transfer it from the retained at the end. Yeah, not the retained at the beginning. The amount we transfer it from the retained profit for the year. Specifically, we transfer it from the profit for the year. Then after that, there is this statement: the company maintains a gross profit margin of 25%. So meaning that if you're told there is a margin of 25%, there is a possibility of having the closing stock, the closing inventory here. So closing inventory, we shall calculate that, the closing inventory. And for the closing, we shall start with our sales. Let me use this one is here. We shall have our sales, and our sales is 150. We have the return inwards, and return inwards, we had return inwards of 32. So here we shall have the net. This is the net sales. Net sales. Net sales, that way. Then we have the cost of sales. Cost of sales. And our cost of sales here, we are starting with the opening inventory, and our inventory here, the opening inventory was 18. We have purchases of where is it? Purchases of 51. We have the return outward. So our return outward was 15, that way. And I think that was all that we had. Then we shall have our closing. Yeah, closing inventory. We shall have our gross profit. So our gross profit here, we are told is 25% of this. 25% of our sales. 25% of our sales. And I can round it off that way. So that is our gross profit, meaning that our cost of sales here, we shall have this, and we minus this. So that will be our cost of sales. Therefore, our closing, so this value, if I can find it here, this one, I just need this total. So here we have these 68, it's not adding up. 68 100. So we shall leave alone with this one because you'll find that this is 68 supposed to be more, so that when we minus the closing we shall get this. But in this case the cost of sales is more than this, so the closing stock cannot be a positive, it's supposed to be a negative value. And for that matter, I'll first leave alone that. I'll leave alone the closing inventory. Yeah, so that's how that first part was supposed to be calculated. The first part, how it was supposed to be calculated. Yeah, so to get the original and the adjustment. So our adjusted trial balance now, if you are to get the adjusted trial balance, we check this and we shall minus this. Then for this one, we check this and we minus this. So cash is direct. That one we don't have anything that way. So this other one is direct. Even this other one is direct. The other one is direct. There is no adjustment here up to that point. So for purchases, we shall adjust by minusing the 150, which was overstated. Then bank overdraft. So there is no adjustment. The two of them. The discount allowed, no adjustment up to this point. For the accumulated, we shall add this one and we drag this. Then this one, audit fee, it was accrued. Yeah, audit fee was accrued. So we shall add the 120. These others were prepaid. We shall minus the prepayment and I will drag the two. So bad debts we shall add. For the bad debts we shall add this one plus this one. There's an additional bad debts. Then allowance, we shall check this at the end. Allowance, we shall take it at the end at 822. Need to know whether we are taking it. Okay, but I think it should be on the debit. I'll come back to that. Then the retained, it will remain the retained. Then prepaid admin, which I'll drag. So accrued will be on the credit. And what else? Interest and loan on the debit. These are down on the credit. So the depreciation, this one. Okay, so for this one, it will be on the debit, and I'll drag the up to this point. All of them will be on the debit. Then the accruals, this one will be on the credit up to that point. The transfer will be on the debit. And you'll find that there is a missing value, and it is this one that I had said that the allowance. This one supposed to be on the debit. The 822 supposed to be on the debit, and still there is a value that is missing. So we are having 205, 814, and 514. So there's a 300 somewhere, either that have not. Yeah, the 300. So here we shall account for the debit, but less. So it will be this, and I less this. Let me see that. Yeah, that one is okay. So I will account for the debit, but less for the allowance 522, which will be expensed. That is what will be expensed in the income statement. It will be expensed, so that will get that particular value, and that is how your adjusted trial balance is supposed to look like. Adjusted trial balance was supposed to look like. Yeah, so for the closing was not, we are not able to calculate that, and the reason is that this value is more. Yeah, so the closing will be a positive instead of a negative. Ideally, it's supposed to be a negative value. So that's how. So we started with the planning, materiality, and remember, benchmark is just a figure that you use according to your own personal judgment. But when you look at the standards, yeah, majority of the standards set under auditing normally lies, revenue is normally lies from 1 to 3, net income 3 to 10%, and this net income sometimes we normally call it the EBIT. Yeah, the profit before interest and tax. Yeah, profit before interest and tax, and the total. Remember, you said when you are setting these, we are considering the user's needs. What are the user's needs? And again, the professional judgment of the auditor comes in play whenever you are setting or you are determining the materiality level. So this question, apart from the first part that was maybe challenging, but the second part, a student could have gotten the 14 marks from the second part. 14 marks from the second part, a student could have gotten that. So thank you. So continue subscribing. September intake is ongoing. Yeah, you can join. Use the numbers from the description. You can either text, you can either call, or you can either WhatsApp. Yeah, the numbers that will be provided under the description so that you can join with us. September intake is ongoing, and most probable classes will be beginning on 12th of September for the BDA. 12th of September for the BDA. So join and learn with the best. Thank you.